If you are a green card holder or an immigrant living in the United States, there is a set of federal banking rules that most people have never been told about. These rules do not target criminals. They apply to everyone, including legal permanent residents, citizens, and working families who simply handle cash as part of their daily lives. Understanding them is not optional. It is necessary. And the reason most people never learn about them is not because the information is hidden. It is because nobody in the banking system, the immigration system, or the legal system is required to explain them to you before something goes wrong. Most people assume that if they are not doing anything illegal, they have nothing to worry about. That assumption is one of the most expensive mistakes an immigrant family can make in America. The federal financial surveillance system does not operate on the basis of guilt or innocence. It operates on the basis of patterns. And the patterns it is looking for are so common, so ordinary, so completely normal in the daily financial lives of working people that millions of families are generating federal reports every single week without any awareness that it is happening. This is not a story about criminals. This is a story about a system that was designed to catch criminals, but captures ordinary people in the process. And the only way to stay outside of it is to understand exactly how it works. Let me walk you through what happened to one man in California and then explain exactly what the law says so you can protect yourself and everyone in your household. In January 2026, a 61-year-old retired engineer in Fremont, California, needed $9,000 in cash to pay a contractor renovating his kitchen. The contractor offered a discount for cash payment, so he went to his bank's ATM and made 3 withdrawals over the course of 1 week. $3,200 on Tuesday, $2,800 on Thursday, and $3,000 on Saturday, all from his own savings, all legally earned money that he had accumulated over decades of professional work. 12 days later, his debit card stopped working without any warning or explanation. His automatic mortgage payment bounced. His wife could not use the card at the grocery store. He called the bank and was told his account was under a compliance review. No further information was provided, no timeline was given, no explanation of what triggered the review was offered. 26 days after his first withdrawal, 2 agents from Homeland Security Investigations knocked on his front door. They were carrying 6 months of his bank records, his most recent tax return, and a printed record of every ATM location he had visited in the prior 90 days. They asked him one question: "Were you sending money to anyone overseas?" He was not. He was paying a contractor for kitchen renovation work. But the federal monitoring algorithm that flagged his account did not know about kitchen renovations. It only saw numbers moving in a pattern it was programmed to identify. He was eventually cleared. But the process took 41 days, cost him over $4,000 in attorney fees, dropped his credit score by 38 points due to the bounced mortgage payment, and resulted in his teenage son's college savings account being temporarily frozen during the compliance review because it was held under the same account profile. His wife could not buy groceries for 11 days. His car insurance payment failed automatically, leaving the vehicle uninsured for 2 weeks without anyone in the family knowing. The financial consequences spread through every corner of his family's life from a single week of ATM withdrawals made for a completely legitimate purpose. He had not done anything wrong. What he had done was trigger an automated compliance system that he did not know existed. And that is the point. The system does not require wrongdoing to activate. It requires patterns. And the patterns it looks for are ones that ordinary people create every day. Here is how that system works, in detail, so you understand exactly what is running in the background every time you interact with your bank account. Under the Bank Secrecy Act of 1970, codified at 31 United States Code Section 53113, every financial institution in the country is required to file a currency transaction report with the Financial Crimes Enforcement Network, known as FinCEN, for any cash transaction exceeding $10,000 in a single business day. This filing is automatic and mandatory. The bank does not ask your permission. They are not required to notify you before filing, during the filing, or after the filing has been submitted. The report includes your full legal name, your social security number or alien identification number, your home address, your date of birth, and the exact transaction amount. It is filed within 15 days of the transaction and becomes immediately accessible to the IRS, the DEA, the FBI, ICE, and hundreds of other federal and state law enforcement agencies through a shared database system. No warrant is required for any of those agencies to access the information. A standard administrative request is sufficient. What most people do not realize is that this system was built specifically to cast a wide net. The $10,000 threshold was not chosen because transactions above that amount are inherently suspicious. It was chosen as a practical reporting line that would allow law enforcement to monitor large cash movements across the financial system. The vast majority of currency transaction reports are filed on completely legal transactions conducted by completely ordinary people. The report itself is not an accusation, but it is a data point in a federal database that stays there permanently and can become part of a broader profile if other reports are added to it over time. The second reporting mechanism is the Suspicious Activity Report, governed by 31 United States Code Section 5318 and its implementing regulation at 31 CFR Section 102320. Banks are required to file this report for any transaction of $5,000 or more that the bank suspects may involve funds from illegal activity, may be designed to avoid reporting requirements, or has no clear lawful purpose the bank can identify. This report is fundamentally different from the currency transaction report in several important ways. First, the threshold is lower, $5,000 rather than $10,000. Second, and far more significant, there is no minimum dollar threshold when the bank suspects a behavioral pattern called structuring. A bank can file a suspicious activity report on a $500 transaction if a compliance officer believes the pattern of behavior across the account looks suspicious. Third, and most critically, under 31 United States Code Section 5318G, the bank is legally prohibited from telling you a suspicious activity report has been filed on your account. If a teller were to mention it to you, that teller would face federal criminal penalties. The report exists in complete secrecy. You have no legal right to know it was filed, no right to contest it, and no right to request a copy of it. It enters the FinCEN database silently and remains there, available to federal agencies without any notification to you that it exists. This is the mechanism that was triggered in the Fremont case. Not the $10,000 currency transaction report threshold, but the behavioral pattern monitoring system that operates beneath it and has no minimum floor when structuring is suspected. The third rule covers monetary instruments. Under 31 CFR Section 1010-415, any cash purchase of a money order, cashier's check, bank draft, or traveler's check between $3,000 and $10,000 requires the bank to record and verify your full identity, your name, your date of birth, your social security number or alien identification number, and your home address are all recorded and retained for 5 years. That record is available to FinCEN and law enforcement on request without a warrant. If you regularly purchase money orders to send support to family members abroad, every single one of those purchases above $3,000 is being recorded and retained in a federal accessible database. Now, here is something that changed specifically in 2026, and that directly affects millions of people living in or traveling through the southern United States. On March 7, 2026, FinCEN issued an expanded geographic targeting order covering money service businesses in designated counties and zip codes across Arizona, California, New Mexico, and Texas. In those covered areas, the reporting threshold for cash transactions at money service businesses was lowered from $10,000 all the way down to $1,000. The counties affected include Maricopa, Pima, Santa Cruz, and Yuma in Arizona. In New Mexico, the covered counties include Bernalillo, Doña Ana, and San Juan. In Texas, the affected counties include Cameron, El Paso, Hidalgo, Maverick, and Webb. In California, multiple zip codes across San Diego and Imperial counties are included in the order, covering significant portions of those communities. If you live in or travel through any of these areas and conduct a cash transaction above $1,000 at a check cashing store, a currency exchange, a money order counter, or any other designated money service business, a federal report is automatically filed with your complete identification attached. That report goes directly into the FinCEN database. This order does not contain any exemption for legal permanent residents. It does not contain any exemption for American citizens. It does not distinguish between someone engaged in criminal activity and a working parent cashing a paycheck at a neighborhood check cashing store. The system captures everyone in those areas equally, and your legal status has no bearing on whether a report is generated. If you live in a covered zip code and cash a paycheck of $2,200 every 2 weeks at a local money service business, you are generating 26 federal reports per year with your name, date of birth, and identification number attached to each one. 26 data points building a profile in the FinCEN database. 26 connections between your cash activity and federal law enforcement systems. The accumulation of those reports over months and years can create a profile that draws attention even when every single transaction was completely legitimate. Now back to the automated internal monitoring system that operates at every major bank in the country. These banks do not only watch for single transactions above $10,000, they run proprietary software continuously across every account they hold, analyzing behavioral patterns across multiple transactions over time. This software looks specifically for multiple cash withdrawals that approach the $3,000 recording threshold in a short period, transactions that show increasing frequency or increasing amounts over time, and cumulative amounts across multiple transactions that together approach the $10,000 currency transaction report threshold. When those three ATM withdrawals totaling $9,000 appeared in sequence in the Fremont engineer's account, the system identified a behavioral pattern consistent with what it was programmed to look for, generated a suspicious activity report internally, and that report moved from the bank to FinCEN to Homeland Security investigations within 72 hours. The entire pipeline from ATM withdrawal to federal agents at the front door ran in less than 4 weeks. There is a specific federal crime related to this behavioral pattern called structuring, defined under 31 United States Code Section 5324. Structuring means deliberately breaking a large transaction into smaller amounts for the purpose of avoiding federal reporting requirements. The maximum federal penalty for structuring is 5 years in federal prison and a fine of $250,000 for individuals. What most people do not know, and what makes this law particularly consequential for ordinary people who have never heard of it, is that you do not need to be aware the law exists to be investigated for it. Federal prosecutors are not required to prove that you knew about currency transaction report thresholds or suspicious activity report requirements. They are only required to demonstrate a pattern of transactions that appeared designed to stay below a reportable threshold. Intent can be inferred from the pattern itself, even when the actual intent was nothing more than making normal purchases. The Institute for Justice documented a case involving a Palestinian-American convenience store owner in Greenville, North Carolina, who had spent 17 years building a legal business after immigrating to the country. He made regular cash deposits from his store's daily earnings. Those amounts frequently fell below $10,000 simply because that is what his business generated each day from legitimate sales. He was never informed by anyone that this deposit pattern could raise compliance concerns under federal law. Federal agents arrived at his store, blocked customers from entering, and presented him with a document titled Consent to Forfeit. His entire account balance, over $150,000 of legally earned money, was seized without a single criminal charge being filed against him. He signed the document under circumstances where agents made comments about consequences for his family members if he refused, and because English was not his first language, he did not fully understand what the document said. His life savings were gone. The Institute for Justice documented that between 2005 and 2012, the IRS seized over $240 million in structuring related cases, and roughly one-third of those cases involved no underlying criminal allegation of any kind. This brings us to civil asset forfeiture, which operates under a completely separate legal framework and has its own set of consequences. Under civil asset forfeiture law, the federal government can seize your cash, your bank account balance, or your physical property without filing a single criminal charge against you as an individual. The government files a legal case against the money itself. The case caption reads literally, United States versus a specific dollar amount in United States currency. The legal standard required for the government to prevail is preponderance of evidence, meaning the government needs to show only that it is more likely than not that the funds are connected to illegal activity. A pattern of ATM withdrawals that approached but stayed below the $10,000 threshold can be presented to the court as the evidence of suspicious behavior. The burden then shifts to you to prove that your money was earned legally. During the months or years that the forfeiture case proceeds, you have zero access to the seized funds. Every automatic payment tied to that account fails. Every bill goes unpaid. Your credit history is damaged payment by payment while your own legally earned money sits in a government account. A dairy farmer in Maryland spent 30 years building a business, selling glass-bottled milk and handmade ice cream at farmers markets where customers paid in cash. A bank teller casually told his wife that keeping deposits under $10,000 would save the bank paperwork on their end. The teller did not mention federal law. The family followed that advice in good faith. The IRS seized nearly $63,000, their entire business account, without filing criminal charges. Federal prosecutors offered a settlement, forfeit $29,500, and the matter would be closed. The family accepted because contesting a civil forfeiture action through the courts typically costs between $15,000 and $25,000 in legal fees alone, according to Institute for Justice litigation data, and the proceedings average 8 to 14 months during which the money remains inaccessible. A dairy farmer lost money he had legally earned over 3 decades because a bank teller gave uninformed advice and nobody in the system was required to tell him the truth before it was too late. Now let us talk about the connection between financial surveillance and immigration enforcement specifically, because this is where the consequences for immigrant families become most severe. When a suspicious activity report is filed on your account, it enters the FinCEN database. Under a data sharing agreement executed between the IRS and ICE in April 2025, ICE submitted information requests covering over 1 million taxpayers. The IRS disclosed financial records for tens of thousands of individuals who matched their enforcement database criteria. 2 federal courts subsequently intervened. A federal court in Washington, D.C. issued a temporary suspension on further IRS data sharing with ICE in late 2025, finding the agreement likely unlawful. A federal court in Massachusetts prohibited DHS from using data obtained through the agreement in February 2026. However, the records already transferred before those court orders were issued were not ordered to be destroyed. That data remains in possession of immigration enforcement and remains accessible to Homeland Security investigations agents building cases. If your financial profile generated a suspicious activity report and your name appeared in the transferred records, your complete financial history is visible to immigration enforcement without you having any knowledge of it and without any further court approval being required. The pipeline from your ATM withdrawal to a federal agent at your front door is not theoretical. It is operational and documented. Understanding this pipeline is the foundation of protecting yourself from it. Here is what you can do starting today to protect yourself and your family. If you need to withdraw a large amount of cash for a legitimate purpose, make a single withdrawal in one transaction on one day rather than spreading it across multiple days. One withdrawal of $9,000 creates a straightforward, transparent record. 3 withdrawals of $3,000 across a week creates the exact behavioral pattern that compliance systems are specifically programmed to identify and flag. The single transaction may still generate a currency transaction report if it crosses the $10,000 threshold, but it creates no suggestion of structuring. Transparency in a single transaction protects you. A pattern of smaller transactions creates the appearance of avoidance, even when no avoidance was intended. Whenever possible, use traceable electronic payments for large transactions. Pay contractors with a bank transfer, a personal check, or an electronic payment service. Pay for vehicles, major renovations, and large purchases through traceable means that create a clear paper record. A bank wire transfer of any amount generates no currency transaction report and no suspicious activity report under the Bank Secrecy Act framework. A large cash withdrawal, depending on your account history and behavioral pattern, creates federal reporting exposure. The same money, the same purpose, the same contractor, and a completely different federal footprint depending on how you move the funds. Know your geographic situation specifically. If you live in or travel through covered counties in Arizona, California, New Mexico, or Texas, your effective reporting threshold at money service businesses is $1,000, not $10,000, through at least September 2026. Avoid using check cashing stores and currency exchange counters for amounts above $1,000 in those areas. Open a standard bank checking account if you do not already have one. Use direct deposit for all income. Build your financial activity on traceable electronic infrastructure that keeps you entirely outside the geographic targeting order reporting system. A bank account with direct deposit is not just convenient. In covered areas, it is a meaningful form of legal protection. Before you make any significant cash withdrawal or large cash transaction, create a written record of why you need it. A contractor invoice, a signed contract, an itemized estimate, a photograph of the work being performed. Before you purchase a money order or cashier's check, write down the recipient, the purpose, and the date. Keep every receipt, every contract, and every piece of written correspondence related to large cash transactions in a dedicated folder that you can access immediately. The Fremont engineer was cleared in 41 days specifically because his attorney was able to produce the renovation contract and the contractor's current business license on the first day of the investigation. Without that documentation, the investigation would have continued for months at significantly greater cost and with continued financial paralysis for his family. Your documentation is not just good record keeping. It is your primary legal defense if the system ever flags your account. If federal agents of any kind appear at your home or business and present a document for your signature, especially any document containing the words consent, forfeiture, voluntary, or waiver anywhere in the text, your only response is this: I would like to speak with my attorney before signing anything. That sentence and nothing else. Do not explain the transaction. Do not describe what the cash was for. Do not apologize for the withdrawal pattern. Do not attempt to demonstrate your innocence through conversation without counsel present. Every statement you make to federal agents without an attorney present can be used to build a case against you, even when your statements are completely truthful. The convenience store owner lost over $150,000 of legally earned money because he signed a document he did not fully understand under circumstances where he felt pressure to comply. You have the absolute constitutional right to decline to sign any document without first consulting an attorney. The Fifth Amendment guarantees your right to remain silent. The Fourth Amendment protects you from unreasonable seizures. These rights exist specifically for moments when federal agents are standing in your home with a folder full of your financial records. Use them without hesitation and without apology. The numbers worth keeping in your memory are these. $10,000 is the standard currency transaction report threshold that applies at every financial institution in the country. $5,000 is the general suspicious activity report threshold, though a report can be filed on any amount if a behavioral pattern is suspected. $3,000 is the threshold for identity recording on monetary instrument purchases. $1,000 is the current geographic targeting order threshold in covered border area counties and zip codes across 4 states. and there is no minimum floor for a suspicious activity report when a bank compliance officer identifies a behavioral pattern they consider worth reporting. The families affected by these systems are not statistics. When the Fremont engineer's account was frozen, his wife could not buy groceries. His car insurance lapsed without anyone knowing. His son's college savings became inaccessible during the review. When the convenience store owner's account was seized, 4 employees went without paychecks for 3 weeks while he borrowed against his home to keep them paid. When the Maryland dairy farmer lost $63,000, he could not purchase feed for his cattle while his money sat in a government account. The cost of not understanding these rules is measured not only in attorney fees and credit score damage. It is measured in groceries that cannot be purchased, employees who cannot be paid, animals that cannot be fed, and parents abroad who stop hearing from their children without understanding why. Every electronic payment you make instead of a cash withdrawal is one fewer federal data point attached to your name. Every transaction you document before you make it is one more layer of protection against an automated system that does not know your history, your character, or your intentions. The system is not personal. It is automated, continuous, and it does not stop running because you were unaware the rules existed. Now you know them. Apply them to your financial life. Share this information with someone in your community who needs to hear it. The protection these rules offer only works when you understand them before something goes wrong, not after. This content is for educational and informational purposes only. It does not constitute legal advice. For guidance specific to your individual situation, consult a licensed immigration attorney or a financial compliance attorney in your jurisdiction.